You opened your brokerage statement last month. You contribute every paycheck, you pick solid funds, and yet something about the growth feels off. Here is why. Your financial institution charges you a different price than the person sitting 10 feet away in the same lobby. Not a slightly different price, a completely different math equation. And the gap between your equation and theirs is widening every quarter. I ran the numbers on what this pricing gap actually costs. For someone with $500,000 invested, the difference between the retail tier and the next tier up comes to roughly $2,100 per year in fees alone. That is before compounding. Over 20 years, that quiet annual gap snowballs into more than $87,000 in wealth you never built. By minute 10, you'll know exactly which tier your bank has had you on, what it's costing you in real dollars, and the 3-phase audit I built to jump to the next one, some of it in a single phone call. And the tax layer, the one I get into around minute 8, that's the part that made me sit back in my chair, because it's not a loophole, it's written into the code, and it's only available past a certain dollar sign. So let me tell you how I stumbled into this. A friend of mine, Denise, 41, earns about $115,000, asked me to look at her portfolio. She had $430,000 across a 401k and a taxable brokerage account. Solid. She was doing better than most people her age. I pulled up her fee structure. Her advisory fee was 0.95% on the taxable account. Her mutual fund expense ratios averaged 0.42%. Combined, she was paying roughly 1.37% annually on every dollar in that account. Look, that doesn't sound like much. Most people hear 1.3% and think, fine, that's the cost of doing business. But here's what 1.37% actually means in dollars she'll never see. On $250,000 in her taxable account at 7% gross return, after 20 years with no fees, it reaches roughly $967,000. With her 1.37% total drag, it reaches about $735,000. That's $232,000 in missing wealth, $250,000, not from bad investments, from the price she was charged to sit at the table. And honestly, she's not doing anything wrong. She's doing almost everything right. The problem is that almost has a price tag, and nobody printed it on her statement. Now, this is the part most people miss. Your bank doesn't charge everyone the same percentage. They use a tiered structure, but they don't volunteer which tier you're on. Here's roughly how it works at most major institutions. Below $250,000 in qualifying assets, you're retail client. You get the standard product shelf, standard fees. Wire transfers cost $25 to $30 each. Your advisory rate, if you're using one, hovers around 1 to 1.25%. Between $250,000 and $1 million, something shifts. At Chase, for example, you hit private client status at $150,000 in combined deposits and investments. Wire fees disappear, you get a dedicated banker. ATM surcharges vanish. That feels like an upgrade, and it is. But here's the thing. Those perks, the waived fees and the phone line, that's the equivalent of getting free breadsticks at a restaurant, while the table next to you is ordering off a completely different kitchen. Stay with me on this. Because the real cost is not what you're paying, it's what you're not being offered. That's the retail tier, one down. But the next two, the ones that open at $1 million and $5 million, that's where the financial physics actually change, and the gap is not a few $1,000s. I'm about to show you the math on what it really is.
Okay, so here is where it gets uncomfortable. At $1 million in investable assets, two things happen simultaneously, and neither one shows up in a welcome letter. First, your advisory fee becomes negotiable. I do not mean slightly negotiable. I mean structurally different. The median advisory fee in the US is about 1% of assets under management. That's the NerdWallet number, that's the smart asset number. That's the industry figure everyone throws around. But here's what nobody tells you at the retail tier. That rate is a starting position, not a fixed price. If you work with a fee-only registered investment advisor, not a broker, not a commission-based planner, a fiduciary, and you have $1 million, a realistic negotiated rate is between 0.20% and 0.35%. I almost did not believe that range the first time I saw it, so I checked it across 4 sources. Same range. The difference between 1% and 0.3% on $1 million over 20 years at 7% growth, roughly $340,000 in preserved wealth. That one surprised me too. One conversation, one negotiation, a third of $1 million in outcome difference. Now I know what you're thinking. I don't have $1 million yet. Stay with me because the acceleration path matters more than the number itself. I'll show you exactly how in the audit section. Second thing that happens at $1 million, and this one is the real gear shift. You become eligible for something the SEC calls an accredited investor. The threshold is $1 million in net worth excluding your primary residence, or $200,000 in individual income for 2 consecutive years. The SEC's own data shows roughly 18.5% of American households currently meet that bar. That means 81.5% of households are locked out of an entire category of investments, not because those investments are too risky, because securities law draws a line and says, above this, you can make your own assessment. And honestly, the products on the other side of that line are not exotic. Private credit funds, private real estate syndications, direct lending vehicles. The global private credit market alone hit roughly $3 trillion at the start of 2025. $3 trillion in a market that most working Americans can't legally participate in. That's not a niche, that's an ocean. And here's what's wild. The people who cross that $1 million line before 40, who get access to these mechanics while compounding still has 25 years of runway, aren't just earning slightly more. They're operating in a different mathematical universe. We're talking about potentially retiring 4 to 6 years earlier, not from picking better stocks, from accessing better architecture. Let me build this out with a real scenario. Take 2 people, Nadia, 36, and Eric, 36. Both earn $125,000, both have $600,000 in investable assets, $380,000 taxable, $220,000 in retirement accounts. Same discipline, same market, same starting line. Nadia stays on her current setup, 0.85% advisory fee, broad index ETFs, no negotiation, no structural changes. Solid by any standard definition. Eric makes 3 mechanical changes the year he crosses $1 million, which at their savings rate happens around age 42. Hold on to both of them because I'm going to show you their numbers at age 58, and the gap is not what you'd guess. Change 1. Eric switches to a fee-only fiduciary and negotiates his advisory rate down to 0.30%. On a $1 million taxable portfolio, that saves roughly $5,500 per year in direct fees. Compounded over 16 years at 7%, that approximately preserves $155,000 in additional wealth. Change 2, Eric implements direct indexing on his taxable account. Instead of holding one S&P 500 ETF, he owns the underlying stocks individually. This lets him harvest losses at the position level during market dips. Vanguard's own research puts the annual after-tax benefit between 1 and 2% for high-income clients. Using a conservative 0.8% over 16 years on $1 million, that adds roughly $165,000 in after-tax wealth. Yeah, just from switching how the same index is held. Change 3, Eric allocates 12% of his taxable portfolio to an accredited investor private credit fund yielding consistent 7.5% distributions versus the 4.2% he was earning on his bond allocation. Over 16 years, the return differential on that slice
adds roughly $72,000 in additional compounded income. Combined additional wealth from 3 mechanical changes, approximately $392,000. Same income, same market, same 22 years of work. Nadia's portfolio at 58, roughly $2.5 million. Eric's, roughly $2.9 million. And somebody at that table goes, Eric must be a better investor. No, Eric accessed a different price list. That's the entire story. Okay, so here is what we know so far. Your bank has tiered pricing. The tier you are on determines your fee structure, your product access, and your negotiation power. The compounding cost of being one tier too low is measured in 6 figures over a working career. But everything we've covered so far is the visible layer, the fees, the fund access, the negotiation window. What I'm about to show you is the invisible layer, the tax architecture that quietly multiplies everything we just calculated. And this next part applies specifically to anyone between $500,000 and $5 million in investable assets. If that is you right now, the next 3 minutes could be the most expensive thing you've ever ignored. There's a strategy used routinely above $1 million in net worth. It has a deliberately blunt name: buy, borrow, die. Here's how it works. You buy appreciating assets, stocks, real estate, private company stakes. You do not sell them ever, because selling triggers the taxable event. Instead, you borrow against them. Banks will lend you money secured by your investment portfolio. These are called securities-backed lines of credit, SBLOCs. You live on that borrowed cash, and here's the key. Loan proceeds are not income. They are not taxed, period. Now, this is the part where I got angry. When you die, your heirs inherit those assets at current market value under something called the stepped-up basis provision. That means the capital gain you accumulated, the one you borrowed against for decades, vanishes. It's never taxed. Under current law in 2026, this provision is fully intact. Let me make the arithmetic concrete. Say you hold $3 million in equities. Over 15 years, it grows to $7 million. Unrealized gain, $4 million. If you sold at the 20% long-term capital gains rate, you pay $800,000 in federal taxes. Instead, you borrow $2 million against the portfolio. Current SBLOC rates at that level, I checked Schwab's published rates, run roughly SOFR plus 1.90 to 3.40%, depending on line size. Right now, that puts you around 5.5% to 7% annually. That's about $110,000 to $140,000 in interest per year, your cost of accessing your own wealth without triggering a tax event. Your assets keep compounding, the gain is never realized, and when you pass, the basis resets. ProPublica published a landmark analysis in 2021. They obtained actual IRS records. The 25 wealthiest Americans saw their combined wealth grow by approximately $401 billion between 2014 and 2018. They paid roughly $13.6 billion in federal income taxes over that period. That's a true tax rate of about 3.4%, not 3.4% of their income, 3.4% of their actual wealth growth. And you probably paid a higher rate on your last paycheck. But here's the thing that reframes all of this. You don't need $401 billion for parts of this architecture to apply to you. Above $1 million in investable assets, securities-backed lending becomes accessible. Above $5 million, the terms get genuinely competitive. The playbook scales down, not all of it, but enough of it to meaningfully change your trajectory. A friend asked me this exact question last week. At what point does any of this actually apply to someone like me? So I built the model, and the answer is earlier than either of us expected. Okay, stop. I've been showing you the problem for 10 minutes. Here's where we fix it. If you're sitting there thinking this system is tilted, yeah, it is. The pricing structure rewards scale, and nobody hands you the updated menu until you ask for it. But here's the thing. Once you see the tiers, you can game the crossover points. I built something I call the Tier-Jump Audit. 3 phases. Each one takes less than a Saturday morning, and the combined effect, based on every data point we just walked through, is 6 figures over a career. Phase 1, price your current tier. Pull your last 4 quarterly statements, find 3 numbers: your total advisory fee as a percentage, your weighted average fund expense ratio, and any transaction fees from the last 12 months. Add them. That's your all-in annual cost rate. This takes about 20 minutes. If your combined rate is above 1%, you're overpaying relative to what's available at your asset level. Write that number down. We're coming back to it. If you earn between $75,000 and $150,000 and have between $300,000 and $1 million invested, this phase alone might be the most valuable 20 minutes of your financial year. Phase 2, map your threshold distance. Calculate exactly how far you are from the next wealth tier. If you're at $680,000, your target is $1 million. At your current savings rate and market return, how many months until you cross it? Here's the move most people don't think of. Can you consolidate? Retirement accounts at one custodian, taxable at another, an old 401k from a job 3 years ago still sitting at Fidelity? Combine them under one advisory umbrella. Many tier thresholds count total household assets under management. Consolidation alone can jump you up a tier without saving an extra dime. And yes, this works even if each individual account is well below the threshold. The institution sees the total. That's how the tiers are calculated. Phase 3, negotiate on arrival. The day you cross $1 million in combined assets, you initiate 2 conversations. First, you call your advisor and request a fee review. The script is simple. I've crossed $1 million in household assets under management. I would like to discuss adjusting my advisory rate to reflect that level. Target, 0.25% to 0.35%. If they hesitate or refuse, that tells you they're operating at a tier below what your assets require. A fee-only fiduciary at this level brings this conversation up without being asked. Second conversation, ask about direct indexing for your taxable account and securities-backed lending. If your advisor doesn't know what direct indexing is or can't explain it in 2 sentences, that's your signal to start interviewing replacements. If you run this audit once and execute all 3 phases, here's what the data says. Fee savings compounded over 20 years, $150,000 to $340,000, depending on your starting assets. Tax alpha from direct indexing, $80,000 to $200,000. Improved access to alternative allocations, $50,000 to $100,000 in additional risk-adjusted return. Combined, between $280,000 and $640,000 of additional lifetime wealth from 3 mechanical changes and 1 honest conversation. Here's the difference. Most people will watch this video and keep paying the same rate tomorrow. They'll stay on the same tier. Not because they can't move, because nobody told them the other tier existed. You now know it exists. The question is whether you pick up the phone on Saturday morning or whether you let the $2,100 per year bleed continue for another decade. The fact that you're still here at minute 13 means you're the type who runs the numbers. So, run them. Remember that $2,100 per year bleed from the opening? Now you know where it comes from, and you have the exact 3-phase playbook to stop it. We talked about the stepped-up basis today, how unrealized gains disappear at death under current law. But there's a provision coming in 2026 that could change how the estate tax exemption interacts with everything we just discussed. The math shifts in a way that most people aren't preparing for. That's the next video, and it rewrites the playbook for anyone building toward $1 million right now. If this is the kind of math your bank will never show you, subscribe. I publish 5 times a week. Every video is another page of the menu they don't hand out at the front desk.